Hey, hello everyone. Thanks for joining in on this Sunday morning. Pretty hot here in Bangalore. Hope you guys are having a slightly cooler day wherever you guys have, sort of logged in from. So today, let's get started with the rebalance discussion. The first point on agenda is, obviously the rebalance related discussion. Then we are going to have a talk around recent macro trends. Then there is going to be a question of mid and small cap conundrum, and then finally we're going to move on to the Q&A aspect of it. Sorry, my technical issue. Okay, so as I was telling you, this is going to be the agenda for the day. So let's jump into it straight away. On the rebalance side of things, a couple of different modern small cases went out first. So on the subscribed models side, value and momentum small case saw a fair amount of churn and four companies. Four companies getting added and four companies getting dropped. Next, we had Cancelimist small case. Cancelimist also saw a fair amount of churn. Five companies dropped and five companies added. With straight flush, we did not see too many changes coming in. So straight flush obviously takes into consideration, the historical growth rate and the expected future EPS growth rate of the company. And then we also look at factors like quality, which is judged by return on equity, balance sheet strength, and all of these things. Not too many changes coming in over there. Low risk smart beta sort of looks at large cap companies from a risk perspective, and we try to ensure that the risk distribution is on the lower side for this company, for these companies, and not too many things changing over there for low risk smart beta also. Growth at fair price obviously saw like a fair amount of churn. One factor that could have contributed to churn is the concept of fair price, since we have seen prices sort of running up. Uh, you know, uh, it will not meet the fair price criteria, which is why the companies would have gotten dropped out. This is as far as modern small cases were concerned. Next, let's move on to non-modern small cases. Let's get started with Jubilant Foodworks. Now, Jubilant Foodworks, couple of different factors sort of affecting the performance of the company. One is the inflation aspect. Uh, what's been happening is the category that Jubilant operates in, which is where the raw material is basically milk and cheese. The inflation has not come down at all, whereas you would have seen that the inflation is sort of flattish for other categories of foods. Cheese and milk inflation has been very, very sticky, which is affecting the raw material prices of the company, in turn affecting the margins of the company. The second aspect that is hurting the company is competition. Pizza as a category itself is facing a lot of competition, both from the organized and unorganized sector. So that's been an issue for the company. And the third factor is store expansion. To sort of drive growth, what the company has been doing is there's been a lot of store expansion happening. And because of the store expansion, we feel that, the balance sheet is going to be under pressure. And we sort of take a slightly conservative approach to balance sheet strength. We absolutely make sure that the balance sheet strength is exceptional for any company that we add to our baskets. We believe that cash is king. Any sort of negative scenario, it is the companies that don't have enough balance sheet strength that are going to get affected first, which is why we sort of took a conservative approach. We drop this small case out of brand value, great Indian middle class, and bringing the bling. Uh, now, focusing on bringing the bling, there are two other changes that we made. One, we added Ethos. Now, Ethos has a monopoly in retailing high-end brands. So what it does is it buys high-end brands from the original manufacturer like Rolex or Tissot or whoever it is, and sort of retail sells it in India via its own showrooms and stuff like that. So this is a company that we've been watching for a couple of different quarters now. We've had multiple rounds of discussion around this particular company, and what we've seen that in spite of like a very challenging discretionary demand scenario, the company has been able to maintain its growth rate. And last but not the least, the recent India EFTA free trade agreement is also sort of expected to benefit the company because of lowering of import duty. So a couple of different things going in for Ethos, which is why we decided to add it. The other company that we added was 361. So this is a HNI focused wealth management company. Fundamental performance has been very, very stable for the company, favorably viewed by institutional brokers as well as other investors, which is why we sort of made sure to add this to the basket. Next, we have HDFC Bank. Now, HDFC Bank is part of both our banking privately as well as banking tracker small case. What's been happening with HDFC Bank is, there recently you would all have read about the merger of HDFC, Housing Development Finance Corporation, and HDFC Bank, because of which HDFC Bank took a whole lot of, home loan products on its books. Now, these are low margin products. That is the first factor that sort of, hit HDFC Bank. And just as a precursor to that discussion, one other factor is HDFC Bank has always been able to maintain a 4% plus net interest margin, which is why the price to book ratio for HDFC Bank had always been on the higher side compared to any other large private sector bank, which means the market was giving it a premium. Now, by taking on this, home loan, products on its books, that is the first factor that affected the net interest margin of the bank. Second factor is because of sort of the scenario that was around us, the bank has been borrowing at higher rates from the wholesale market, and it's not been able to transfer this higher rates by charging higher rates from people who take loans from the bank, which is the second factor why the net interest margin is under pressure. Now, just to give you a little bit more context into that, during the third quarter of FY24, that is the December 2023 quarter, the bank was in terms of NIM, there was so much of pressure on NIM was, the bank had to sort of sell away its liquid assets, government securities and stuff like that to shore up the NIM to get it up to 3.4%. So the market has certainly not appreciated what has been happening with, the net interest margin for the bank. And because of this, there's been fair amount of pricing pressure on that. If you sort of look at the charts of HDFC Bank since the last 3 years, the price performance has been very, very flattish. But at the same time, one has to concede that, it's a quality franchisee. There is no, apart from the, sort of growth not coming through and the company has not been able to maintain its NIMs, there are no other factors that are sort of affecting it in terms of NPA or anything of the sort. They have been expanding fairly aggressively. Because of which we have not dropped this company from any basket. We've sort of, just reduced the weights. Now, another small case that I would like to touch upon is specialty chemicals. Chemicals as a sector itself has not been doing well. Specialty chemicals, the problem still continues. A couple of different global factors has been sort of affecting, this particular theme. There's been demand issues. There's been a lot of dumping happening from China. All of these factors have sort of pulled down the performance of the basket. We've also made sure to sort of keep only very, very quality companies within our basket. We have exited a bunch of companies Tata Chintan Pharma and the likes, which we felt were not fundamentally up to the mark. This time around, we are adding PCBL to the basket. So PCBL is a India-based player that is into manufacturing carbon black. Carbon black has applications in making tires, in coatings, paint coatings, inks, plastics, and technical rubber. Technical rubber itself has a lot of applications in various industries and in automotive sector as well. So overall, I think this is a very, very good theme fit for us. Fundamental performance, in spite of all the problems with the industry, fundamental performance has been very, very good. And obviously, because of the pressures with the industry, the company has sort of undervalued. Which is why we thought it is a good add at this stage. So last but not the least, another small case that I would like to discuss is InfraTracker. InfraTracker, obviously, sort of a lot of the play right now is because of the capex spent by the government. And 3 companies we've added to the basket, and all of them are sort of expected to benefit because of the capex spent by the government. One of them is NTPC. Apart from the government's capex spend, there's also an aggressive foray into renewable energy. for NTPC, and we feel that's going to be a positive for the stock. We saw what Tata Power's foray into renewable energy did for the stock price, and let's hope that the same happens with NTPC as well. The second company is Titagar Rail Systems. Now, Titagar Rail Systems is a specialty railway stock. It has recently won orders for Vande Bharat trains, and it also has an exceptionally high order book, 13,650 crores. So, to sort of put it into context, the trailing 12-month revenue for the company was somewhere in the 3,800 range. So, it's almost 3 years worth of order book that they have on their end. So, their order book is 3 times their trailing 12 months revenue. Finally, we have Jupiter Wagons, once again, specialty, company which is involved in railways. This company is also expected to benefit because of the increased capex in railways, and as well as whatever has been happening, the new dedicated freight corridors that are coming up and the likes. So this is as far as the rebalancing related discussion was concerned. Now let's quickly move on to what's been happening with the macro trends. I specifically want to discuss capex cycle. A little bit of this discussion we already did that, back in February after the budget announcement. There was a discussion that we already had. So I just wanted to elaborate on that. I just wanted to discuss a trends that we've been seeing with the GDP growth and leading from there what the performance is expected to be like. The capex cycle part of it. Let's take a look at. I think there's a little bit of choppy internet. Just give me one quick second. I'm sorry, we've been having all sorts of technical issues today. I think we missed a little bit of the presentation, so let me just quickly walk you through that once again. Just give me. Okay. Hopefully we are back now. Okay. I think we missed some part of the discussion, so let me just quickly walk you through infra tracker aspects again, and hopefully that should sort of set us on course for the next part of the discussion. Now I'm repeating this section because I think there's been a little bit of issue with my internet, and some part of it was lost. So I'm just trying to make sure that everybody is up to speed on this part of the discussion. Obviously, three major additions that we made to the infra tracker was one on NTPC. And obviously, a lot of this infra tracker theme itself is based on whatever is the capex spending of the government. So NTPC is expected to be a major beneficiary of that capex spend. Another factor that sort of works in NTPC's favor is the company's foray into renewable energy. Now we've all seen that what Tata Power's foray into renewable energy did for the stock price, and let's hope the same thing happens with NTPC, and there is a similar re-rating of the stock price for the company. The second company was Titagar. Now this is a specialty rail systems company. They have been very active in winning orders for Vande Bharat trains. They also have a huge order book of 30,650 crore rupees. And if you sort of look at it from a trading 12 months perspective, I think it is about 3 times their trading 12 months revenue, the order book. Lastly, Jupiter Wagon Systems, once again, specialty trading company. This company is also expected to benefit because of increased capex in railways and dedicated freight corridors. So that was the recap for those who lost connection and were not able to hear. Let's move on to macro trends. So like I was telling you, capex cycle discussion, we've already had it in February, but I just want to elaborate on that and make sure that we are all on the same page as far as the various different factors that's been happening around the capex cycle. Now, before actually jumping into capex cycle, I wanted to touch upon gross fixed capital formation. Now, this is a fairly advanced economic word. What does gross fixed capital formation actually mean? So, anytime a country makes additions in terms of fixed capital, which is like factories, roads, bridges, airports, ports, and all of these things, they get counted as fixed capital formation within a country. Now, for a country like India, where we always, hear about infrastructure not being up to the mark and stuff like that, gross fixed capital formation is a number that sort of everybody keenly watches, right? Uh, so what you can see here is gross fixed capital as a percentage of GDP has been constantly increasing. It was around 30% range, and during the first half of 2024, it has reached to 35% of the spending, right? And this 35% is probably an all-time high for India, right? So this gross fixed capital formation, there's been a lot of focus by the government, and it is being pushed through. Now, for the gross fixed capital formation to happen, there has to be the capex cycle, which means there has to be the capital expenditure coming in from various sources. Now, there are three sources of capital expenditure. First one is the government capex. What does the government do? The government builds highways, the government builds ports, or obviously it gets it built by the private players, or airports and bridges and dams and these kinds of things. What is private capex? Private capex refers to any expansion of factories and the likes by companies. Now you would have seen that obviously because the government is spending a lot of money on railways, companies like NTPC or Titagar or Jupiter Wagons or whoever will say, okay, now we are going to get a lot of orders. What we're going to do is we will have to set up a new factory somewhere else, right? That is the private capex. The third aspect, the third pillar of the capex cycle is the housing demand from individuals like you and me, right? We like as government's capex kicks through, the private capex increases, money in the economy increases. Hopefully a lot more people are going to get employed and stuff like that, and once there is like stable source of income, the demand for housing increases. So these are the three basic pillars of capex cycle. Now, what had been happening since 2019? I take the 2019 point because that is when like sort of COVID started. A lot of people lost their jobs, a lot of troubles within the economy and stuff like that. And the capex cycle had started going down. There was not a lot of private capex. There was not a lot of demand for housing and stuff like that because people did not have a lot of money. What the government did was it pushed in through a lot of money via government capex. Now the private capex has started kicking off, and the housing capex has also come on back. Now let's look at a couple of different numbers. Let's start with the government capex. You can see that this capital expenditure from the government as well as granting aid creation of capital asset. This is the amount of money that the central government gives to the states for capital expenditure within their borders, right? So if tomorrow Karnataka government decides that they want to build a dam somewhere, they can approach the central government, and based on after feasibility study and stuff like that, the central government will approve a loan and will approve a grant. It is not even a loan for the dam to come up, right? A lot of metro projects across different Indian cities, there is it sort of comes in as a partnership between state government spending plus central government spending. That is where this money gets spent. And obviously, you can see that increasing tower over a period of time. And especially after 2021-22, when COVID hit us, the tower has started increasing very, very steeply. All right. It's almost like since FY21, it's almost like a 2 or 3x increase in capex spending. Now, what has happened on the government side, whatever is the capex, that has obviously started positively affecting private non-financial capex. Now, you can see that FY 2021 was a low point, 3.7 lakh crore. Now, all of this money that I'm talking about here is in lakh crore. So just sort of please remember that. Now, here in this slide, let's look at the private capex, and you can see the 3.7 lakh crore was the the low point in FY 2021, and subsequently we have moved on to 4.8 and 5.9 in 2023, and you can see that if you compare the half yearly numbers for FY23 and FY24, there's been an increase. So that is the private capex sort of kicking in. You can see a lot of these announcements coming in via papers and stuff like that. If you are like, if you look at the economic section of your newspaper or papers like Economic Times and stuff like that, these announcements are there for everyone to see on a daily basis. Next one is the housing aspect of it, which is people like you and me, what is it that we are doing? One aspect of it is what has been happening to banking credit. So banking credit for housing has sort of been increasing. You can see that between FY21 to 23, bank credit for housing as a percentage of GDP has sort of flatlined 7.5, 7.4, 7.3. But then in FY24, it has started picking up from there. It has reached 8.7 levels. And this is data that is available till November 2023, but there is no reason to believe that anything has happened since the last 4 or 5 months that the numbers would have reversed. So that is there, and you can see that that mortgage rate has flatlined since November 2022, and you can see that residential sales, at least in the top 7 cities, that is the data that's available, is very easily available to us. That sort of has started picking up, right? That residential sales versus mortgage trend, you can see that it has started picking up. So just to conclude, 3 pillars of capex cycle: government, private, and housing. And we obviously can see that all 3 of them have started checking the box, right? And this is not something that gets over within 3 months, 6 months, 12 months. The benefits of this capex cycle goes on for years together. So in terms of macro trends, I think we are heading in the right direction. Now, I think let's move on to the last part, which I think all of you sort of want to hear, which is what's been happening with mid and small cap companies. There's been a little bit of correction, and sort of everybody's been we've received quite a few people writing in to us saying that okay, my so and so small cap has corrected. Should I book profits now? What should I be doing with mid and small cap companies in my basket, and all of these things? So we just want to discuss what's been happening with mid and small cap companies and what should sort of be a very fair approach to take as far as these companies are concerned. Now let's get started. First, let's look at what's been happening to the price of mid and small cap companies. The last two boxes there are what we should be looking at: mid cap Nifty mid cap 150 and Nifty small cap 250. Now you can see that over the last 1 year, compared to any other index, these indices have performed extremely well. Nifty mid cap 150 is up 57.28%, and Nifty small cap 250 is up 68.80%. But then look at the performance over the last 1 month, 3 months, and 6 months, right? Especially over the last 6 months. 22.79% performance for Nifty mid cap 150, and then 28.23% performance for Nifty small cap 250. So all of these factors shows that during the first half of the year, we saw a lot of momentum, not so much of momentum coming in these years, but in the recent days. The second part of the chart talks about rolling returns of these indices. So the Nifty 50 total return index, Nifty mid cap 150 and Nifty small cap 150, you can see that it almost looks like a crocodile's mouth. The dark blue line that you're seeing there is Nifty 50 total return index. The performance has been good, but sort of like it's not in an overvalued category or anything of that sort. But the other two blue lines that you see over there, one is the greenish tinged line and the other one blue line, you can see that it has significantly jumped up since March 23, right? So that is what has happened to the performance for these two indices. Now, what's been happening to the valuation? Obviously, the first most important line here is the middle greenish line, light greenish line, which is the historical average number. And the other two numbers, the one at the top and the one at the bottom, refer to the average one standard deviation line. Okay. Now you can see that for Nifty mid cap, this is the 1 year forward PE, by the way. You can see that the Nifty and 1 year forward PE shot up, till February 2024, and then now there has been a significant correction. It has started reaching the historical average line. The same thing has happened with Nifty small cap also. There's been a shoot up since February 2023, steep correction, but still it is not anywhere close to the historical average that it has been trading at. So just keep this factor in mind. Now, this is about price performance and valuation. Now, let's move on to the next part, which is what has been happening to the earnings growth. Now, you can see that the first box talks about Nifty mid cap 150 index in the last 2 years. So that is the index value. On 28 February 2022, it was at 10,621, and on 29 February, it was at 17,000. So that is a 68% change. What happened to the PE ratio of this particular index during the same time? It went up from 26.83 to 26.96. So just 0.5% change. But what has happened to the EPS of the constituents of this index? went up from 396 to 661, which is a 67% change. So what is the takeaway from here? Whatever rally has happened, for Nifty Mid Cap Index, right? Most of that rally is not a re-rating of the PE ratio, right? The rally is because the EPS of these companies have started growing. Very similar change in terms of Nifty Small Cap 250 also. Index value is up 68%. PE ratio, little bit of re-rating has happened 10%, but 53% is because of change in earnings growth, right? That is the change in earnings growth that has happened. So whatever is the uptrend that we have been seeing is because of this change in the earnings profile of the underlying companies. So it's not just a lot of gas that is sort of like, money is coming into the market. There is no basis for it. And hence the indices are, running up. That is not what's been happening at all. There's been a lot of earnings per share, change for these companies. The earnings per share has been growing rapidly. Because of which there's been a uptrend in the indices. Now, let's look at a couple of other things also in terms of what are the sectors that are sort of seeing a lot of earnings growth. You can leave the top line weights part of it. Look at Q3 FY24 top line growth section, large caps, and then SMID. SMID refers to small and mid cap companies. And then look at the Q3 FY24 profit growth, right? Once again, large caps and SMID. You can obviously see that, sectors like auto, pharmaceuticals, industrials, private banks, all of these have been seeing a lot of profit after tax growth compared to that of the large cap companies. Now the top line growth is not so great. You can see that for auto companies, the top line growth for small and mid cap companies came in at 8%. For large caps, it was at 20%. But the profit after tax growth was exceptionally high. Same thing happening with pharmaceutical companies. Top line growth 10 and 11% for large and SMID companies, but profit after tax growth 23 and 59, right? Very similarly, look at metals and mining companies in the second section. 2 and 5% growth in top line, but 59 and 67% growth in profit after tax. Very similarly for PSU banks, same thing happening with IT companies also. IT companies, at least the top line growth is slightly higher for SMID companies. Now, there are sectors where, the small and mid cap companies are not doing so well. Obvious places being, sectors like paints, a lot of competitive intensity, a lot of margin pressure to be seen. Infrastructure companies have been doing pretty on par with each other, the large and mid cap as well as the small cap companies. But then this sort of shows what I've been talking about in the previous slide, that, small and mid cap companies, lot of earnings growth improvement happening, which is why these companies have continued to do well in terms of market performance. Now, if you look at what is happening to the balance sheet, you can see that these companies, small cap companies, have been sort of trying to deleverage their balance sheet. In FY 2020, it was at the gearing ratio. Gearing ratio is basically debt to equity ratio. Was at in 2020 it was at 0.63, and you can see that steep drawn to 0.3. Right, these are FY23 numbers. In like a couple of months' time, we'll get to see what has happened with the FY24 numbers also. And my guess is that the trend is going to the downward trend, or at least a flattish line is expected to continue. So this sort of gives us a picture of what's been actually happening with mid and small cap companies. So to sort of, in conclusion, to summarize everything, price run up definitely been there for both mid and small cap companies. Valuation definitely on the higher side for both mid and small cap companies, though we have seen some corrections and the likes. However, what is going in favor of mid and small cap companies is, one, the sort of improvement in the macro environment. Capex cycle is is sort of there. It's been firing on all cylinders. Government capex has been very, very robust. Private capex has started coming online. Housing demand has been pretty great, and it is not just government numbers. We've sort of been seeing all of these announcements and the likes in the newspapers from private companies also. Earnings growth prospect is pretty positive for mid and small cap companies. We've all seen the numbers, and then the balance sheet also is quite healthy for all of these companies, right? So in conclusion, this is what has been happening. However, we need to be pretty careful in terms of our approach to investing in mid and small cap companies. So let's see where these mid and small cap companies have to sort of sit within our basket. right? Now we've already, I think, a couple of months ago when I had a discussion around what is the best way to approach mid and small cap companies, I had shared the same slide, and I had said, like, there has to be a core and satellite approach to investing. The core of your portfolio should always be in stable, diversified investments. Large cap companies, a little bit of debt, a little bit of gold, and all of these factors. A good way to track your investments within the core aspect of it is sort of like, use ETFs. And the focus here in the core part of the portfolio is that you should be looking at stable long-term returns that is ideal for all types of market conditions, right? Whether market is doing well, whether market is not doing well, the core of the portfolio should be designed in such a way that the wealth creation journey is very, very smooth, right? Now, there is a satellite part of your portfolio that has to come into focus as well. Obviously, depending on your risk profile, your age, responsibilities, and stuff like that, the proportion of your core and satellite will change. But then the idea of a core and satellite is very true for everybody. Your mid and small cap investments usually has to come in the satellite part of your portfolio, right? This satellite part of it should include stocks that have potential for high returns, but there is also sort of a risk aspect to it, which is where your mid and small cap comes in, obviously, right? And this satellite part of your portfolio is what enhances the overall portfolio returns. Now, the core part allows for smooth wealth creation journey, but for those spikes coming in to, like, sort of that, high returns to come in, it is where the satellite part of it comes in. So just be very, very careful, just be in your understanding of this core portfolio and satellite portfolio, and ensure that you have a sufficient, regardless of your age and risk profile, ensure you have a sufficient core, and your mid and small cap investment has to come in the satellite part of the portfolio only, right? So don't always go ahead and invest only in mid and small cap stocks because, like, you want high returns. That is not the way it should work at all. So in conclusion, what is the best way to invest in mid and small cap stocks? Given the present market conditions, first one, avoid large lump sum allocation, right? That bonus kicks in, some inheritance kicks in, somewhere else, maybe you won a lottery, I don't know. Don't make sure that there is no large lump sum allocation to mid and small cap stocks at this point in time. Reduce, second part, right? If you are overexposed to mid and small caps, I talked about it in the previous slide also. If your satellite itself is very, very huge, make sure that there is an appropriate discussion about how much risk you can take. Reach out to a competent investment advisor, get a little bit of insight into how much risk you should be taking given your age, given your dependence and stuff like that. Make sure that if you are overexposed to mid and small cap stocks, please go ahead and reduce it, reallocate your portfolio, make sure that that your investment journey is smart, right? And the final aspect, continue with your SIP investment, right? Do not, just because I'm saying, like, avoid and reduce, like, do not take out all the money from your mid and small cap stocks. If there is an over allocation, you definitely go ahead and reduce. If you have some lump sum amount of money, don't go ahead and put all of that into mid and small cap stocks. But if you have an SIP, right, and if the time frame is suitably long, then go ahead and continue to invest in these mid and small cap stocks, right? There is no reason for you to move away from mid and small cap stocks completely. It is just that you have to be very smart in terms of your, in terms of how much money you allocate to it and how you're going to play this entire mid and small cap cycle, right? So this sort of brings me to the end of the session. We can now open the floor for questions. So first of all, let me apologize. A fair amount of technical issues today with choppy internet and stuff like that. So let me get started with the questions. The first one, Nirmal Pandey. Hi, I've invested 10 lakhs in value and momentum small case. My question is how much maximum money one should or can invest in this fund? Is this fund ideal for 50 lakh or 1 crore? Thanks. Okay, sir, Nirmal, I hope I've answered your question with the, with the discussion around mid and small cap stocks. Value and momentum is full of small cap companies, mid and small cap companies. So obviously reach out to a investment advisor, competent investment advisor. Make sure that your allocation to value and momentum or any other small case or mid and small cap stock is within your risk profile range, right? That is the right approach to it. If you have a SIP going in, SIP sort of active for a value and momentum small case, my suggestion is continue with it as long as you have a long-term, view of your investment with that small case, right? So hopefully that answers your question. Next, I think a lot of people complaining about the internet issues. Sorry about that. Kamal is asking, is this webinar on every Sunday at 11 a.m.? No, it is not on every Sunday. Whenever we have something to discuss, we send out a notification. You would have gotten the notification via mail and I guess WhatsApp as well, and you can join in. Nirmal Pandey, we as investors are always in confusion because managers say wealth is created by investing for long term in a stock, but others say folio should be rebalanced every quarter like value and momentum. So I think like this discussion around value and momentum or any other model small case sort of like we've had it every time and we sort of get answered these questions. So let me answer it once again. See what happens with value and momentum or any other model small cases. We add companies into the basket and remove companies from the basket based on whether these companies meet the model criteria or not. Okay, so because of which there are certain changes made to the value and momentum basket. Now you could go ahead and rebalance your value and momentum. What does it mean? Then the question is, what does it mean for somebody to say invest for the long term? Invest for the long term in value and momentum, right? Stay invested in value and momentum. Don't sort of keep profit booking once every 6 months or 8 months and stuff like that. Obviously, I'm not asking you not to sell if you need the money, but just in terms of profit booking and stuff like that, don't do that, right? Go in with a smart allocation of your money, set up SIPs and make sure that these SIPs run continuously for a long period of time. Have a, if it is mid and small caps, I'll always say to all my investors, have a outlook of at least 4 to 7 years. Rebalance can keep getting done, right? There are certain stocks which are not doing well. We will exit that. There are certain stocks which are going to do well or meet the model criteria. We are going to do that, and you're going to sort of make sure the rebalance is done. Those things can be done. But as far as value and momentum itself is concerned, you should stay invested in that particular small case for a long period of time. Rishabh is asking the same question again. Can someone throw light? When is the right time to rebalance the portfolio? It is the right time. If you're talking about small cases, whenever we push a rebalance update, then it is the right time to, rebalance the portfolio. Narayan is asking, I'm doing an SIP in all weather investing small case to Zerodha. I'm getting a message to do rebalance. What will happen if I'm not doing anything? Nothing will happen, Narayan. Your investments will sort of the weightage of your investments will deviate from the weightage of the model portfolio that we maintain on our end. So the return profile will also deviate over a period of time. Now, there is no compulsion from our side that you should rebalance, but there is a fair amount of material that we have put out as to what happens if you don't do rebalance. This return profile is obviously one thing. If you want any more material, I can just send it out. Just write it to support@windmill.capital. I'll send out some blog links that we have put out. You can take a look at those blog links to understand why we do rebalances and what should investors approach to the same be. Saumyajit is asking, looks like price and valuation for small and mid cap stocks corrected significantly. Shall we start the dip? I think my presentation answered that question, Saumyajit. Nirmal Pandey, hi, when do you anticipate the interest rates to go down and what impact it will have on stocks, small case like value and momentum? So interest rates, it's not my personal opinion. Obviously, my knowledge is based on whatever research reports I have read. And the expectation is that during the second half of the year, there might be obviously there are like a lot of factors coming into picture over here, like inflation, what happens to rains, in June, and all of these factors. The expectation is that if everything goes right in the second half of the year, there might be lowering of interest rate numbers. And I can't comment on it in terms of what will happen to value and momentum if the interest rate goes down, but the general handed down advice is when interest rate goes down, stock markets tend to do well. Rahul Tucker, how do we book profits in staggered manner from small case? Any particular strategy? There is no any strategy for booking profits, Rahul. It is based on you can use partial exit mechanism to sort of pull any money that you wish to from the small case. Basavraj Basavraj Jaya Hiremat is asking, is it okay to invest lump sum in large cap in the current market situation? See, I personally, I will never suggest that you go ahead and invest a lump sum amount of money because a couple of different things are happening. One, there is elections coming up, right? Well, we all have our political preferences. That is not the important factor. If the like everybody watches the news and there is a certain expectation in terms of how the election is expected to go. Now, if it does not happen like that, which is quite possible, I mean, we've seen that historically. 2004, I think, was a good 20 years ago. What happened to the Vajpayee government, I think, is a good reminder that the market does not always get it right, or the exit polls or whatever other surveys do not get it right. So if something like that happens, there might be a steep correction in the market. So keep that factor in mind when it comes to making any sort of lump sum investments in the current market situation. My current small case is negative by 10%. What to do? Sir, Regan Bharti is asking this question. Sir, I really cannot provide any advice or suggestion on your specific situation because we are research analysts. There are compliance reasons around why we cannot sort of give you any suggestions or recommendations. And I don't even know which small case you're invested in. So based on these factors, I would suggest you reach out to a competent investment advisor. Given the way markets are and stuff like that, just ensure that he or she looks at it and is able to give you good advice around what to do. Sambit Kar is asking, will you rebalance naked trader due to the current volatility? No. Once again, we have touched on this question multiple times. Rebalance is not done because there is volatility in the market. Volatility in the market is always going to be there. That is, volatility is because how all investors make money in the market, right? If there was no volatility, it would be like a bank FD. You wouldn't make money in the markets. So that's not really a factor. It got rebalanced only on 1st March, and we are not going to rebalance it anytime soon. Apart from whenever is the scheduled rebalance time. Deepak Mishra, can we get timely instruction from your side to book profit like rebalance update? There is something called Nifty alerts that gets generated for all investors. You can go on to smallcase.com and under disclosures, you can see what these Nifty alerts are. Based on these Nifty alerts, you can take a call on what to do with your small case, Deepak. Just read that. If you don't know where to find it, write into support@windmill.capital. I'll share that article with you. You can take a look at it and then sort of act on it. Sanjeev is asking, is it the right time to add money at current levels? Sure. If you have a long-term view, suggestion is go via SIP. Ranjit Reddy, is it okay to continue SIP in small and mid cap for 10 years? If you have a long-term view via SIP, certainly, why not? Sachin Sahu is saying, can we see more correction in mid and small caps? I don't know. I don't really have an idea what's going to happen to the market. But considering that, it's sort of overvalued at this stage still, there might continue to be some more correction, right? Basavaraja is asking, what happens if I miss rebalance and do the next one? Then, like I told you, Basavaraja, I suggest you write to Windmill, support@windmill.capital. I'll share some literature with you around rebalances. To answer your question in short, nothing happens. Your return profile might change slightly compared to what happens on the model, what happens to the model portfolio that we maintain. When you rebalance it the next time around, we will ensure that your existing small case, the constituents and the weight closely matches that of the model portfolio. Tejas, but this time the stock market bubble statement came from SEBI just after there was a rebalance update. The situation like this harmful for small cap portfolio. Well, I think a part of the sort of meltdown that we've recently seen is because of the statements that came out. Does it have harmful? I don't know whether you mean small cap portfolio or small case portfolio. Well, I'll go with the assumption that you're talking about small cap portfolio. Part of the sort of meltdown happened because of suggestions like that, because there was sort of expectation that there might be some regulatory move. Nirmal Pandey, how should one invest in both mutual funds and small case for the purpose of diversification? So your investment advisor will be in a better position to sort of look at all of these things and answer your question. Gaurav Ajmera, are PSUs overvalued? PSUs are a very broad category, sir. So you will have to be very specific in terms of which PSUs are you talking about. I personally track a lot of public sector banks. I don't think they are overvalued at all when compared to the sector. I think they are sort of undervalued, which is why we continue to see a lot of momentum in these stocks. I think because of all of these factors, we've even added Canada Bank to our banking tracker small case, because it was one of the factors that we looked at when we saw Canada Bank was it was steeply valued when compared to the overall sector price to book. Vikram Chauhan is saying, sir, please say something on electric mobility. Sir, I think this is a long-term theme. We might see sort of stabilization in demand or sort of moderation in demand in the near term. But over the long term, I think the government focus is definitely there. Lot of capex being done by different companies like Hero, Bajaj, Mahindra and Mahindra. Maruti has also made some announcement around that. A lot of these things are happening, on the electric vehicle side. Companies like Amara Raja and Exide are setting up, large factories in Telangana and in Karnataka to sort of provide, battery technology and stuff like that. So I think this is a space that we are watching with fair amount of interest, and we are fairly bullish about the future prospects of this particular theme. Well, there are questions around is the correction over? Will it be choppy till election? I have no idea. Honestly, I have no idea. I don't want to pass any judgment about what will happen. Brokers at I'm close to retirement age. In what type of mutual fund or small case should I invest to create a retirement fund? Sir, please reach out to a competent investment advisor. Like I told you, we are research analysts here at Windmill Capital. Due to SEBI regulations, we will not be able to provide any recommendations or suggestions around how to do your personal portfolio, financial planning and the likes of that. How is Tata Small Case going to perform? Ayush Saxena is asking. Well, so far it has performed fairly well. I think Tata is the Tata group itself is doing really well. There are a lot of companies which have like Titan and Tata Power and stuff like that, which has contributed to the performance of the small case. There are a whole bunch of IPOs of new companies also coming up. So it's going to be interesting to see how those companies are going to perform. Planning to rebalance the AG Mandi flagship small case. It's not our small case, sir. Nothing to do with Windmill Capital. Do you think small cap portfolios and small cap have an advantage over small cap mutual funds? I don't know. I don't think our position has any day been that you should buy into small cap small cases because it has an advantage over obviously from if you look at it from a cost angle, there is certainly an advantage. If you look at it from a disclosure angle, in terms of you get to see what are all the stocks that you are holding, you get to talk with the fund manager and ask him all sorts of questions around that particular small case. I think these are some of the advantages we offer over a mutual funds. So I hope that answers your question. Okay, Aman Bhatnagar. Hi, earlier my value and momentum small case had very good returns, but now it has corrected a lot. I'm panicking a little. Just paid small case renewal fee a month back. Should I invest more? Good time. I hope the presentation answered your question. Lump sum investments don't do. If you're overexposed, please don't be. If you are going to invest in small caps or in value and momentum, which gives you a lot of exposure to mid and small cap companies, then certainly you should have a long-term view and continue to do it. That's my personal opinion. Now, Rishabh is asking, what is the maximum amount we can allocate to a small case? Is there some capping on that? From our side, there is certainly no capping on what is the maximum amount that can be invested. But from your personal risk profile perspective, my suggestion is reach out to a competent investment advisor. Make sure that there is appropriate amount of correct correct type of risk profiling done, and then only go ahead and sort of start allocating to small cases. I think that sort of brings us to the end of the discussion. We've had a fairly long session, 15 minutes. And sorry for all the technical troubles. Let's hope, we don't run into these next time round. So just before winding up, these are some of the disclaimers, like I already told you. This is based on all the information that we have presented here is based on our research and analysis. And obviously, this does not guarantee any specific profits to you. And as research analysts, we are not allowed to give you any sort of recommendations or suggestions. So please don't treat anything that I have discussed over here as suggestion or a recommendation, right? And we are a SEBI registered research analyst. You can find more details about us on our website if you don't already know about us. So thank you. Hope you have a nice Sunday. Thanks. Bye.